Hello, welcome back. About a week ago, I made a video about how to read an income statement, and I am following this up with a video on how to read the balance sheet statement. And I just have to ask if you like this kind of videos, please leave a like, and if you are enjoying this kind of content, you can also subscribe. Leaving a like really helps. These videos take hours to make, really, to compile and pretty much edit. And so that would be nice of you if you can leave a like. Thank you for that. So let's start off with this one and see what we're going to examine. Now, previously we talked about Apple, the income statement of Apple, and we're gonna be continuing with Apple in this slide as well, in this video as well. I do start with this slide over here just to let you know that we are talking about Apple here, and this is like the first page of their 2021 report. That's the 10K report. So let's start off with what we're seeing here. And the first thing that you see in the balance sheet of the company here, Apple, is a breakdown of the assets of the company. Now, assets are generally typically divided into two categories. This is the current assets and the non-current assets. Now, when we're talking about current assets, we are generally speaking talking about all those assets that can be liquidated in the next 12 months. Oops. And for example, money, cash itself, of course, is already liquidated, but there are also cash equivalents, which are assets like bank accounts, for example, or marketable securities, or short-term bonds. These can be liquidated very quickly in the next 12 months, so they are current assets. Accounts receivable, for example, are some funds, some money that customers owe to our company, to Apple in this case. This is like invoiced, but they are not paid yet, so we're expecting to receive those, and so these are recorded as current assets. Inventories are finished products which obviously have a price, have a value that the company will be selling shortly, and so these are also recorded as current assets expected to be sold in the next 12 months. So vendor non-trade receivables here is actually money that the company expects to receive, but it's not related to the core business, like products or services that Apple is selling. An example could be the company lending money to an employee for some travel costs that it's expecting to get back. Okay, so non-current assets now, on the other hand, are those that the company is holding for more than 12 months. And this can lead to a long-term income generation. For example, marketable securities, you will see them in both non-current assets and current assets. The difference is that these ones are short-term assets, while these ones is assets that the company is not really intending to sell in the next 12 months, even though they can. And so a company's property, plant, and equipment, for example, is listed as a non-current asset because it's difficult to sell in the short term. So it's a long-term asset, like buildings, for example, or equipment that the company is using. This cannot be sold in the next 12 months necessarily. And other typical non-current assets can be intangibles and goodwill. Now, intangibles are these assets that are not physical, that can still lead to making money though. For instance, a copyright or a patent, we can actually utilize this to generate money because we have less competition, for example, and potentially even more brand awareness or things of that sort. Now, goodwill, on the other hand, is the extra value a company has, because if you're buying a company like Coca-Cola, it's not only about the assets that the company has or the money that it generates, it's also about the customer base, the market recognition, the branding that the company has, or some proprietary technology, maybe the recipe of the Coca-Cola itself. And so this is a breakdown of the total assets of the company, and the total assets is the addition of the current assets and the non-current assets, of course, and it's recorded at a specific period of time. Now remember, the balance sheet is actually a snapshot of a very specific period in time, and this is why it has a date here. This is September 25, and so this may not be the same in September 26, the exact same thing. The balance sheet could be different the next day, pretty much. Okay, moving on to a little bit of a more complex section here, but bear with me, we're going to analyze everything so that you can fully understand what is going on here. Now, over here, you will see basically a breakdown of what the company is doing in terms of liabilities and shareholders' equity. Liabilities is basically money that the company needs to pay. Some debt, for example, that the company may have, and they are generally divided into two categories as well: current liabilities and non-current liabilities. And so current liabilities refers to money that the company needs to pay to creditors in the next 12 months, like short-term debt pretty much, or liabilities, short-term liabilities to say it more correctly. Like for instance, accounts payable is money that the company owes to vendors that have been invoiced but not paid yet. So we have gotten some, let's say, product, but we haven't paid for it yet. And this is a liability for the company because it's owed. Deferred revenue, as you can see it recorded here in this line, is money the company has received from payments, even though the product or service has not been fully delivered yet. For example, we may be actually selling a subscription service. We are a company that is selling a subscription service that is prepaid in the beginning of the year. This is deferred revenue because it has been paid, but it hasn't been fully fulfilled yet for our customer. Commercial paper is some short-term loans that the company can actually generate and issue, basically sell to retailers, for example, so to people really, or wealthy individuals, as it used to be in the old days. And these loans tend to mature in like 6 to 9 months. And so they are considered current liabilities because the company is owing money to the creditors, to the people who actually got the debt. So term debt here is the total number of debt owed in the next 12 months, pretty much, because it's a current liability. And term debt, as you can see here, is similar to the marketable securities we examined earlier for the assets. It can also be long-term, as you will see, and it needs to be paid in more than 12 months. It's more like long-term debt. And so non-current liabilities is money that the company needs to pay in the long term, so more than 12 months. It doesn't have to be paid shortly. Examples, for instance, could be like long-term borrowings or loans, or for example, leasings for office space, which can be quite lengthy, like many years. And this will be a non-current liability. Now, when you are a shareholder of a company, you have part of the equity of the company. And this shareholders equity in total is listed in this section over here. Now, you will see common stock and additional paid-in capital. And that may be a little bit difficult to understand, because common stock is the amount of shares held by common shareholders. But there is two things here, the par value and the paid-in capital. So first of all, shares authorized that you can see here is the max amount of shares a company can issue, but that can also be changed in voting. So if the board decides after voting that they need to issue more shares, then this number can actually change and you have a higher number here. So it's not actually limiting the company necessarily. Paid-in capital now is the market value the stock was sold for. Because when a company is issuing shares, it doesn't sell them on par value. It sells them on market value. So if the market value is, let's say, $10, it's gonna sell the stock for $10, not this 0.001 cent or something of that sort, which is a very, very low value that has to be there because of some states, some legal issues for some legal requirements actually from some states. This is why this is used. It's a legal requirement pretty much. But the thing is, paid-in capital is basically the difference between getting the market amount, so selling some outstanding shares multiplied by a market value, minus the outstanding shares multiplied by the par value. And so the paid-in capital is actually the difference between these. And this, sometimes in some reports you can see them in two separate places. But over here you will see the common stock and additional paid-in capital, which is like the common stock par value plus the additional paid-in capital that was received by selling the stock. This is a breakdown. Okay, so hopefully that makes sense. And retained earnings is also part of shareholders' equity. Why? Because retained earnings is profits that the business has accumulated over time. And the thing to understand here is that retained earnings is like a permanent account. It's accumulating over the years. And so net income is an account as well, but it's temporary. It changes with every statement. It goes back to zero. And its activity is actually recorded by the retained earnings account. And so the accumulation of profits and losses that we are closing out on the net income accounts pretty much is recorded as retained earnings. And if a company is paying dividends, for instance, this value will decrease because we are paying back money to shareholders. And so thus you can understand why paying back dividends to shareholders decreases the total stock shareholders' equity, as it would be expected. And this is recorded here. Okay, so we are also seeing accumulated other comprehensive income or loss. So similarly, there is some income because a company's net income is not just made from operations. It could be made, for example, by non-operational income, like for instance unrealized gains on investments. And so this is also recorded here, but it's recorded as accumulated other comprehensive income. And similarly to the retained earnings pretty much account that we have, which is permanent, we also have a permanent accumulated comprehensive income account, which actually records all the changes to the comprehensive income or losses. Hopefully, again, that makes a little bit of sense. But the company is actually, in the next slide, has a breakdown. The company actually creates a breakdown in order to understand exactly what is going on with these values, which we'll examine. But before we do that, it's also worthwhile noting that the total liabilities and shareholders' equity, you may be wondering why they even mention this here. The reason, and it's useful actually to know, is because the total liabilities, when added to the shareholders' equity, must always be the same as the total assets of the company. And you can actually see that the total assets of the company is $351 billion. Now, a little bit later, I'm going to go back to our tool, and you will see how this breaks down with our tool and how you can actually see all these values here. Okay. Next up, you will see a breakdown of total shareholders' equity here, the thing that I mentioned earlier, and it has a beginning balance and an ending balance. Now, the beginning balance is basically the ending of the previous year, or the previous period, really. And in this case, you will see a breakdown of the common stock. So it starts with the common stock, and remember, it's exactly what we examined earlier. It's just a breakdown of the previous slide. So, again, the beginning balance is over here, and it breaks down the stock, the common stock that has been issued, for example, over here, with the common stock that has been withheld, for instance, is also excluded here, deducted. This has to do with RSU payments, is some taxes withheld stock, and also some share-based compensation for employees here. And this breaks it down to what the common stock and additional paid-in capital balance is right now in terms of the company's assets here. And the retained earnings here, again, it is a breakdown of the permanent retained earnings accounts. And because it is permanent, it continues from the previous years, 45, 14, as you will see. And it breaks down to the net income of the company minus what we discussed earlier, like dividends that the company is paying, and common stock related to net settlement of equity awards, common stock repurchased as well. So things of that sort, like things that are deducted from this, are recorded here, and this is the ending balance of the retained earnings, again, at an account that is permanent. And so you will see these values being the beginning balance of the next period, the next year in this case. And again, a breakdown of the accumulated comprehensive income or loss, which is similar to the retained earnings account. And again, you will see a loss of 406 million, again recorded here as the beginning balance. And it breaks down what happened in terms of the company's comprehensive income or loss over here. Okay, so now I'm gonna take a little bit of a quick look just to see how this breaks down in our tool. So let's take a little bit of a look there. So, for example, you will see that September 25, 2021, you will see that our total current assets are 134.8 billion here. And if you go back to our tool, you will see that they are 134.8 billion, and there is the breakdown that you are seeing here, exactly as you're seeing it here. And similarly, the total assets, for instance, of the company, I'm not going to be breaking down everything, of course, but the total assets of the company, you will see that they are 351 billion, that's 2021. So 351 billion, and if you go here, you will see 351. It's always rounded up or down a little bit, just to make it more humanly readable, of course. But the actual values are used with all calculations that the tool is making, of course. So that's one thing. And if you move on, for example, you will see here, again, similar things, current liabilities, non-current liabilities, and you will see again 125, 287 billion is what is recorded here, 125, 260, 162 over here for the non-current liabilities, as you'll see. And this is actually a breakdown of the whole thing, like the total current liabilities, the total non-current liabilities, and at the end it creates the total liabilities, the full thing, which is 287.9, and you can see it here. If we go down to the total liability section, 287.9. So you can basically use the actual statement here to see that everything matches with the tool, and it breaks it down to a nice view over here. And again, you can see that the equity portion is mentioned here, is what we examined at the next slide, which talks about the total common stock that the company has, for example, total shareholders equity. And you can find a full breakdown of how this is calculated here, which is common stock plus retained earnings plus other comprehensive income, is exactly what we examine here. Common stock plus retained earnings plus accumulated or other comprehensive income. 50/14, for example, is what you're seeing here. And actually, if I go back, this is 57, sorry, because we're talking about the ending balance. So 57.3, so the ending balance, 57.3. And then we have the retained earnings. Whoops, somehow I stopped that. My bad, let me go back. And so, yeah, this is 5.5, for example, and 5.5 is here, and 163. So, yeah, this breaks down to the whole thing, and you can see that how the equity breaks down in the view of our tool here. And yeah, this is how you actually get to the numbers. This is what everything means in terms of the balance sheet of the company. I try to make a breakdown that pretty much discusses everything in terms of how the balance sheet works, and kind of correlated with the tool here, because you can see that you can very quickly, for example, take a look at the full equity of the company and then see how the total assets minus the total liability gives you this equity. Because it is what? It is the common stock plus the retained earnings plus the accumulated income or loss. This is how it breaks down in terms of the balance sheet. And that actually hopefully gives you a good idea of how to use the balance sheet and how to use the tool to get an exact idea of what the company is doing. Because what you can clearly see here, for example, is that we had this kind of assets, this kind of liabilities. This produced this total equity, which breaks down to this: the common stock plus retained earnings plus other accumulated comprehensive income and loss. And this is your equity as a shareholder. Okay, so hopefully that video was useful to you. Please remember to leave a like and subscribe if you enjoyed this one. And I will leave in the description a link in the description box below, of course, with the other video that I have made about how to read the income statement. And I'll see you in the next one, in which I'm gonna be talking about the cash flow statement. It's the last one, the last one that we haven't talked about yet. And in the meantime, if you haven't watched it, you can actually just now go to our video on how to read the net income statement. I'm linking that right above. You can actually see the link right now. And I'll see you in the next video. Bye bye.